Hi everyone, welcome to this week's Tyche Talk. And for those who don't know, you're new to the club, Club Tyche. But it's it's almost weekly, talks I have with experts of different fields just to bring some knowledge to you guys. And if you have any questions, be sure to put them in the little question thing or comments, and I'll be sure to ask Ariel when it's time. Not when it's time, when I see it. So feel free to go ahead and ask questions or make comments or anything. Put in a little comment box. Um, so today we have a return speaker. I wish I had a little pop
Yeah,
thing,
some
but
sort of like whee,
yeah,
fireworks.
like a little confetti thing. There we go. We could pretend like we had a champagne bottle. We have Ariel Nathanson, and she's going to help us understand investing principles in 2024. And I was super excited to have her back because we had such a great time last time talking about we talked about finances, but was it I know your site is finances for feminists, and I'm like, I can't remember if that was the topic, but we're talking about finances in general. And so I'm super excited to have her back to talk about investing. So let me tell you a little bit about her. She's a certified financial education instructor and a founder of Finances for Feminists. After leaving her corporate job as a software executive, Ariel set out to demystify the world of personal finance by offering one-on-one financial coaching. Her business is focused on helping women and couples attain financial wellness through education and personalized support. As a money coach, she provides individualized lessons in finance fundamentals, such as budgeting, retirement, investing, that we're going to talk about today, or more, that helps her clients gain clarity and take control of their financial future. So everyone, join me in welcoming Ariel. Yay!
Thank you
I'm
so
glad to
much,
have you.
Lauren. Yeah, I'm so excited to be back as a, second time here. And
Yes.
we share our Wellesley roots, Wellesley College. And actually today just dropped an episode recording with the Wellesley Seven, or I'm sorry, the Seven Sisters alum podcast. So this is a very
Really?
timely discussion we're having all around. Lots of Seven Sisters networks, and everyone's talking about money. It's March, it's Women's History Month, like you have up in your the back of your, what is that called? Screensaver
Yes.
backdrop. And
Yeah.
April is Financial Literacy Month and also Tax Month. So yeah, we're just like diving in head first. I love it.
Yeah, I'm just going to ignore that last one. And I can't ignore it because they'll come after me. But for those of you who don't know, the Seven Sisters is just Seven Sisters podcast. There's another word in there.
I think it's called Conversations with
Okay.
Seven Sisters. I think that's the name of it.
Okay. Conversations with Seven Sisters podcast is a podcast you can download. I follow it on Apple, so I'm sure it's on all of the
Yeah.
Spotify and all of them. So you can join that Conversations with Seven Sisters, and it's referring to the Seven Sister colleges. But and Ariel apparently just dropped it. Do you know when it's going to be out?
Oh, what was that?
Do you know when your
Oh,
episode's
it's
going to be out?
today. It's today. That's what I
Today.
was
It's
saying. Like
okay.
it's timely. Yeah, sorry. Yeah, I'm very much in the Seven Sisters mindset today. So today, yeah.
Oh, okay.
Yeah.
Awesome. So you can get a double dose of Ariel. You can listen to the podcast after this. You can watch this. You can come back and see it later. You can do a triple dose. So just I just you might hear me, my voice is a little weird. I might cough or whatever because I'm getting over something. I call it the preschool plague and it keeps coming back.
Oh, yes. Never ending. I've heard of that. Yeah,
Never.
constantly
Yes.
evolving.
It's yeah. So why don't we just dive right in? And the name of your business is Finances for Feminists. So can you talk a little bit and combine the title, the name of your business with our topic today? Can you tell me or talk to us about why investing is a feminist issue?
Yes, I would love to share more about that. So I'm really passionate about sharing investing in ways that are accessible, easy to understand, and things that we can all do. Now, I believe that, well, I don't believe, but that this data supports that investing is a feminist issue because women are underinvested. So
Mhm.
according to a BlackRock study from 2016, up to 71% of assets held by women are held in cash or cash-like equivalents. So savings accounts, checking accounts, things like that. So up to 71%. And folks may be thinking, okay, but what's the problem? Money is money. Well, holding cash instead of investing is actually a losing game because with inflation, cash loses value over time. Whereas the stock market historically earns 10% on average annually. You may have heard that statistic before. Now, when I say 10% average annually, I don't mean every year you're getting 10% returns. That could
Right.
look like one year we get 20% returns, the next year we get -10, and then averages out to 10%. But when we compare holding cash and losing value with the stock market return, it is a losing value. It is losing game to not invest.
Mhm.
So when we think about inflation, that may be a term that it's like, okay, this like vague thing. But when you think about inflation, it's like the cost of things cost more later. So if I were to buy a movie ticket 20 years ago, that would be, I don't know, like $7. I'm actually trying to remember, like, what did a movie ticket cost? Maybe like
Yeah.
$7. And now I think it's like 17. I don't even know. It's like expensive to go see a movie. So
True.
that's when we talk about inflation, like your money doesn't go as far. So you're actually losing value by holding your money in cash than if you were to invest in the stock market. And the reason why we all need to invest, it's important for everyone, is because in this country, in order to, retire, in order to age and hopefully live off our assets, we need to build wealth through investing. So
Mhm.
it's not like a special thing for special people. It's an everybody thing for everybody. And in particular, it's a long-term wealth building strategy. So it's not a get rich quick scheme where we want to invest today and pull money out tomorrow. That's basically gambling, which, fine if you want to put your fund money towards that, but let's not put our retirement savings or anything remotely important in terms of quick turnarounds. Investing is all about long-term wealth building, and we all need to be invested just in order to safely retire, in order to safely age, in order to support ourselves, because we don't have the social safety nets in this country, at least in the US, to rely on. So it's critical for everybody, really important.
So, what makes it a feminist issue though? Because is it because women are under invested?
Yeah.
Is that why?
Yes, because women are underinvested. So that is something that we need to close that gap. And we need to basically, there's a few things that are at play there. There's, education in terms of the basics where you feel comfortable, but then there's also understanding why it matters, right? So I think it's
Mhm.
twofold. So why it matters for everyone because we are all gonna, age and we're all gonna, some people say, oh, I'm just gonna work forever. And that is really tricky because there are circumstances outside of our control that maybe keep us from working,
Mhm.
either, physically, mentally, or perhaps the industry you're in.
Pandemics.
Yes, yes. So there's all sorts of reasons why we need that sort of nest egg. And I'm really focusing on retirement because that's something that we all need to be aware of, and aging is something we all experience, but you can also invest for other things, like your kids' education is another example. There's lots of opportunities to invest. But I like the retirement example because we are all going to age. Ideally we grow old and get to, live off of our savings for a while, right?
Yeah.
And even if that's not the plan, we need to basically look at the data, look at our numbers where we are versus where we want to be, and start working towards that. So it's a feminist issue because women are underinvested, and I believe we need to sort of shift that and address it. Yeah.
So outside of not investing, or I guess I will start with not investing. What are some of the pitfalls that you see with your clients when it comes to investing?
Yeah. So I think folks sometimes want to try to time the market. So that is a dangerous game and you will never win. If you do it right, it's called insider trading. If you know what's happening, that's insider trading and you'll go to jail like Martha Stewart. And like, so you can't really time the market, right? If you're like, oh, there's going to be a recession this year, I'm going to buy low and sell high. Don't bother. You'll make yourself crazy. And yet
Yes.
people really do try to do it. It's amazing to me how many people I talk to and they're like, well, I'm going to wait to buy. And I'm just like, this is not a thing you want to try to time. So don't try to time the market, right? Investing is all about long-term wealth building. It's not a get rich quick scheme, as we talked about. It's not about like buying today, selling tomorrow, making a quick profit. It's long-term wealth building. And another thing I would say is understanding that volatility is normal. So a pitfall that I see is sometimes there's like a fear or a misunderstanding around stock market volatility. So the example I like to go back to is 2008 because I graduated on the heels of the '08 recession. Many folks will remember that either personally or in their close circles, how it impacted them. It was the Great Recession. It was really bad. And the stock market lost about 55% of its value in that year. So the reason why I like to look at that though, is because if you zoom out, if you like zoom in and you're like, oh, remember '08, that was real rough. And then if you zoom out, the stock market trajectory is still this positive upward trend. Like even including the '08 recession, which was not that long ago, it was like 15 years ago, even including that, the stock market still historically returns 10% average annualized returns. So an example is the S&P 500. So the S&P 500 it stands for the largest 500 stocks in the US domestic economy. So pretty much any US company you can think of that's publicly traded would be included, like Amazon, Microsoft, Apple, all these big companies. So if you owned an S&P 500, if you own that tiny sliver of all those big companies, if you own some of that stock in S&P 500, let's say you owned $100,000 worth. So it's like that was the value of it in '08. And then, like I said, in '08, it dropped 55%. So by the end of the year, that $100,000 would have been worth like $45,000. Now, like, just take a guess as to what that $100,000 would be if you had held on to it, didn't like freak out when the market tanked, just like held your horses 15 years later. Any guesses as to what it would be in 2023 dollars?
175.
$436,000.
Stop it.
Yeah, I know. And so I like that example because we remember, oh, wait, it wasn't that long ago. It was very bad. And so that's just a good reminder that, like, okay, even when things are really bad, like, even when the headlines are really bad, we're doing this for long-term wealth building. We're zooming out. And when you own stocks, you're not like locking in the wins or the losses until you sell. So if you held on to that $100,000 value in 2008 dollars and just didn't sell and just stayed the course in 2023, that would have grown to $436,000. And you can see all these statistics are online if you want to like play with the numbers, but volatility is normal, and that's part of investing in companies. They're volatile, and so we can't be afraid of those sort of ups and downs. We have to sort of see that as a part of investing, and that we know holistically, including, if you look at that 100,000 to the 436, it's basically that 10% annualized adjusted down for inflation. It's just like everything is exactly as the statistics say, even including that really, really tricky year in '08. So volatility is normal. Don't try to time the market. And then the third thing I would say is don't wait until you're like, don't feel like you need to attain some sort of like investing guru status. Like we may feel like I will be hit by a beam of light and feel like I'm ready to do this, right? Like you don't need to be expert status. You can just like start where you are. And like the most important thing is to start now, start today. And if you belong in any sort of workplace sponsored account, like if you have a workplace sponsored retirement account, like 401k, a 403b, anything like that, it's super easy to invest. You just go to your HR, you say like divert some of my paycheck here, and they will likely have default investments that you can choose, like target date funds or things like that, which I'll just quickly define what that is. Target date funds basically make your portfolio more conservative as you get closer to the date that you picked. So it's not like you have to submit paperwork when you like hit the date. It's more just holistically making your portfolio more conservative as you get closer to that age. And so that's often a lot of defaults for HR companies. So you can just like, if your workplace sponsors that, and I know you and I are self-employed, so we don't have that option, but there are options for self-employed people too for retirement, retirement workplace sponsored accounts like SEP IRAs, solo 401ks. So there are ways to do it, and just don't expect to feel like, I'm suddenly an expert. I feel like I've attained Yoda status. Like, start where you are. That's most important.
So that kind of, that's a perfect segue to a question I have. So someone's watching this and they're like, awesome, bet I'm on it. I'm ready. I'm in a position starting later in life. I'm in a position to be able to invest outside of a 401k or 529 for kids education. Where can someone start? Like just like, oh, okay, I want to put in $100 a week. I don't know. Like something, how can someone get started investing?
Yeah. Yeah. So I'll talk about the account options first. So retirement account options are things that have tax incentives. So the government basically says, man, it's really expensive to retire. And let me just say, retirement is more expensive than buying a house, having kids, going to college, because we're essentially living off of our savings for ideally decades, right? So that is why I keep mentioning retirement. And a good rule of thumb is multiplying your current income by 25. So if you make 80K, it's like 2 million that you want to have ultimately for your retirement nest egg, which sounds like a lot of money, right? So the government says, yikes, retirement is expensive. We want to incentivize you to save. So there are certain retirement accounts available. So workplace sponsored accounts are the things I mentioned: 401k for a for-profit, 403(b) for nonprofits. There's TSP for like federal employees, but those are through your workplace, meaning you only have access to them if your employer sets them up. So to do that, you would go to your HR, say, I want to divert some of my paycheck here, and that's honestly the easiest way. And also, you may have heard of like a 401k match. Some companies match contributions, which is great. So that's essentially free money. And so you would ideally try to get that match. It's happening less and less though. So like, I feel like it's a little bit dated advice to like get the 401k match. But if you have it, if your company does offer it, that's great. So that's workplace sponsored accounts. Now for self-employed people, you can do it yourself in terms of SEP IRA if you're like a business owner or a solo 401k. These are basically as the employer, like you or me in our own businesses, we would want to set that up. And that's how we could save for retirement. Now, let's say your company or business doesn't have a retirement account. There's no 401k, there's no 403(b). You can save through what's called a Roth or a traditional IRA. And IRA stands for individual retirement account. So this is me as an individual. I am opening this account on behalf of myself. You can only put earned income towards that. So you can't like, I don't know, you can't have like rental property and put it in there, the income from that. It has to be earned income. And the reason for that is that the government is like taxing this stuff at income tax levels. So it needs it to be earned income in order to set it aside for retirement. Now, so that's a Roth, a traditional IRA. Each of these have different amounts that you can contribute. And I'm hoping, like I still have people and they're not totally zoned out yet, but so IRAs have like each year they change it a little bit. You can contribute up to 7,000 if you're under age 50. And then there's like a catch-up clause if you're over age 50. Meanwhile, 401ks, 403bs, you can contribute up to $23,000, I think. I think last year was 22,500. They change it every year. But that's a pretty big difference in terms of like, you know, how much you can contribute. So IRAs, actually, it's not that much. It's like $7,000 this year if you're under 50, as I mentioned. So, so if you want to save for retirement and you say like, okay, let's use the example of a Roth IRA. So you basically, you can either like call a bank or, like go to your bank and say like, hey, I want to open this. You can do it online. You can do it on the phone. You can go to like brick and mortar if you prefer that. Some people have different preferences. All of this is really easy to do online. They've really made it super easy, but you can
Yeah.
open those accounts and fund them. Just remember, for all these retirement accounts, there's rules with them because the government is like, if we're going to give you tax incentives, and that's, I should say, when I say retirement accounts have benefits, it's tax incentives. So basically, there's tax incentives to save for retirement, but the stick, so if the carrot is the tax incentives, the stick is you can only access them within certain rules. So like you have to wait until you're 59 and a half and you have to withdraw certain minimum distributions. So that's all, nitty gritty stuff. But the point is retirement is a big thing you can save for it. There are tax incentives to do it, but meaning that that those funds have to be used for retirement. The other way you can invest, let's say, aside from retirement, is just a regular brokerage account. So maybe you've like maxed out maybe you're just like crushing it and you've already, maxed out your Roth or your IRA. Maybe you've maxed out your 401k. That would be a very significant savings. So like, bravo. But let's say you want to do something else and you're like, well, I want to invest, but I don't want to wait to access these funds until I've retired. I may want to access them sooner, like 10 years out or 15 or something. So you can open what's called a brokerage account. So unlike a checking or a savings account, this is basically, back in the day, you would call a stock broker, which is why it's called a brokerage account, even though today you can do everything online without like interacting with a person. But if you want to open a brokerage account, that would be how you could invest outside of retirement. So you would open a brokerage account and then you would then have to, there's 3 steps. You open the account, you fund the account, and then you have to pick your investment. So that's step 3. So I feel like I just threw a lot at you, Lawrence.
No. That's good to know. People can figure out like, oh, okay, this is what I want to do. Depending on if you work for yourself or you work for someone else, or if you're like, you know what, I just want to invest in my own. So when we're talking about investments, can you briefly explain the difference between stocks and bonds?
Yes. So those are really the core investment asset classes. So when we talk about ETFs, when we talk about index funds, we're just talking about like groups of these things, groups of stocks and bonds, and also cash. But cash, we don't really need to identify as much. Stocks and bonds are a little more like, what is this? So a bond is basically a contract with a government, either federal or local or a company. So if you've heard of, when you think about investing in the US government, that's called a treasury bond. So you may have heard of a treasury bond. So that's like one example. So the way we make money on bonds, they're generally considered more fixed or stable. We earn interest. So it's basically the interest that we're being paid for loaning or being the loaners of our money to these governments or companies. So they're paying a little bit of interest. They're saying, thank you for the money. Thank you for loaning us some money. We're going to give you some interest to sweeten the deal. So that's how we make money off bonds. And they're generally considered more fixed or stable investments because they're generally considered to be more conservative, more reliable, and less risky. So there's always this trade-off between risk and reward with investing, where something less risky tends to have lower rewards. This isn't always true. There are exceptions, but things that are more risky, like investing in companies, which is what stocks are, have higher returns. So a stock is basically a fixed percentage of ownership in a company. So those examples I gave before of that, like, Apple, let's use Apple stock. So if you bought 0.01% of Apple stock in the 80s, the Apple company, the value of that in the 80s would have been like teeny, tiny, that 0.01%. If you had held on to it like 40 years later in 2024, that 0.01% of Apple stock is going to be worth a lot more. So that's called price appreciation. So the way we make money on stocks is twofold. One is price appreciation. That's like the Apple stock example. And the other is a dividend payout where the company says, thank you for being a shareholder. And, we want to reward you with some dividends. So that's just like a payout basically. So when I use that Apple example, usually we're not as individuals investing in individual stocks. That's not what most people do, the majority of investors do. Usually what we do is we're investing in large swaths of companies. So an example would be the S&P 500, where you're investing in like 500 companies, but you have little tiny slivers of each of them, right? So the reason why that's good is because we don't want to put all of our eggs in one basket. So if we're fully invested in Apple stock and something happens to Apple, then there goes all of our savings, right? But if we're invested in 500 different companies and one of them, or, you know, a handful of them, or even, you know, in 2008, even let's say all of them kind of tanked a little bit, then, you know, you're still diversifying. You're not invested in like one company. So that's also known as like equity. So if you see on like statements, if you're looking at statements, you might see under bonds, fixed stable investments, and under stocks, equity is another name for those two halves.
I am. So we do have a question,
Oh,
an
great.
audience question from Carol. So the question she has, what are the benefits with Roth versus standard IRAs?
Yeah. So I should explain the distinction. So Roth versus traditional, those are like the two kinds of IRAs. As we said, IRA stands for individual retirement account, or they're also called IRAs. I've heard both. That's just the way in which the taxes happen. So either way, you're paying income taxes, but Roth, you pay income taxes today. So if I contribute, like in 2023, I contributed to my Roth, it was $6,500 was the max at that time. And I'm paying taxes now for 2023. I would pay taxes on that Roth investment. I would pay income taxes up front, meaning later when I withdraw those funds in retirement, I'm not paying income taxes. I already paid them. I'm not paying them twice. Now, traditional means you pay income taxes later. So if I were to put that 6,500 in 2023, I'm doing my taxes 2024 for last year. I'm not paying taxes on that money. I am not paying taxes on that 6,500. I pay taxes later when I withdraw the funds from retirement. So the difference between Roth versus traditional is just taxes. Do you want to be taxed now, or do you want to be taxed later? Does that answer the question, or was she asking more generally what's so great about?
It just says what are the benefits of Roth versus the standard. I think usually when people talk about the two, they do talk about the tax deferrals versus tax. I don't
Right.
know, tax now. Well, I don't know what the opposite of tax or deferral term is. But Carol, if you're still on, if there's a follow-up, go ahead and put that follow-up in. I don't know. Do you have a couple extra minutes, Ariel?
Sure. Yeah. Yeah.
Okay. So yes, Carol, if you have a follow-up, or if anyone else you have follow-up, please go ahead and put it in there. We'll get to them as soon as we see them. So yes, okay. This is what I get like I love talking about money. I know that's like a taboo thing, but even in law school, I study security. So I study like stocks. I did securities arbitration. So I'm like, tell more about it.
Oh, wow.
Yeah.
That's a very dense topic.
I guess it came easily. So
Yeah, nice.
uh, Carol said thank you. It was very helpful.
Oh,
So
good.
yes,
Great. Great, great, great.
answered her question. So do you have any fun statistics about investing? Because the first statistic you gave was kind of sad.
That was a bummer. Yeah, that was a bummer of a statistic. Yes, I have a lot of fun statistics. So one is that women are actually, years of research has proven that women are better investors than men. So there's a couple of really fun articles if you want to read up on these. There's a New York Times op-ed piece from 2019 that the title is "Let Me Mansplain to You Why Women Are Better Investors Than Men," which is really funny. And essentially what it says is that women stockbrokers, or fund managers, I should say, women fund managers, were shown to sort of like stay the course and stick with the plan, and as a result have higher outcomes financially than their male counterparts. Whereas men, when things turn rocky, like in that '08 example, they were trying to like move money around and like, ooh, let's see if I can like dodge this, you know, situation and get out of it. And as a result, they locked in their losses, because the thing about investing is that you don't lock in your gains or your losses until you sell. So, so that's kind of a fun statistic, that years of research has proven that women are better investors than men. Another, this isn't a statistic, but it is a hilarious article that it's from Forbes 2013, so it is older, but 10 years was not that long ago.
No.
You can check it out. It's Forbes 2013. In it, this team did a study with 3 groups of people: a cat, a group of school children, and a team of professional money managers. You may have heard this before. And they basically gave them a pool of money and they said, make this grow, right? Like invest it, see what happens. How can you invest it and who has the best outcome? So at the end of the year, any guesses of those 3, which was the winner? The cat, the group of school children, or the team of professional money managers?
The cat, money man. What was the middle one?
A group of school children.
I'm going with a cat. I would have said octopus, but that wasn't an option.
No, but octopi are very smart. Yes, they are.
Yes.
The cat, you're right. It was the cat. And I just like crack up every time I read this, but this is like the direct quote from the Forbes article. The cat selected stocks by throwing his favorite toy mouse on a grid of numbers allocated to different companies, and the cat won. So what I like to use this statistic or study to illustrate is not that like professional money managers or fund managers are bad at their job or evil or sleeping at their desk. That's not it at all. Instead, they're doing an impossible job, which is trying to predict the future, right? Like they are trying to say, okay, how many cars were in the Tesla parking lot? And like, is it going to go up? And they're basically trying to outperform the market. And that is very, very, very hard to do. And in this example, like the cat did better, right? So it's really hard to outperform the market. So when we talk about that 10% annualized return, that's what we're talking about as like the market. And so it's hard to sort of cover all the like really important statistics or really important terms in a short amount of time, but I'll just throw this out there. So like index funds are basically, there's index versus actively managed funds. Index funds basically say, I want the average, I'm happy with the average, I love the average. And the average is that 10%, right? So we are thrilled with the average. We love the average. Actively managed funds, you're paying someone to move your money around to outperform the average. They're saying, we can do better than the average. We can do better than that 10%. And this statistic shows that the cat did better than those professional money managers, right? So for a lot of folks, and this is an educational presentation. I'm not like telling people, I don't know their specific investment circumstances, but for a lot of folks, index funds work really well because the average works really well for them. And we know that trying to actively outperform the market, A, costs more money. That's the big point, I should say. You're paying someone to move your money around. And B, they tend to underperform the vast majority of the time. This was one like little fun fact, but if you Google like, do actively managed funds outperform index funds, you'll see a lot of results showing that like that is not typically the case. So you're paying more for not any better outcomes, basically.
So I was writing down, I'm like, where are they? So for those of you who are still on, I actually have a New York Times subscription. I can gift 10 articles, I think a month or something.
Oh
So the
yeah,
first
give
10
them.
people to
Yeah.
send me their email and tell me they want the articles, you DM me in the, not in the chat. Don't put it in the chat. If you're already on LinkedIn, just message me in LinkedIn with your email address saying you want the New York Times article. So for the first 10 people, I'll go ahead and send you the link. It'll be like a gift link. I don't know what it says on the receiver's end. Maybe like Lauren sent you
The,
this
the,
article.
the title of that opinion article, Lauren, is Consider Firing Your Male Broker. And then the subtitle is Years of Research Show Female Investors Outperform Men.
Is that the Forbes one?
No,
Or the
that's the New York Times, because you said New York Times, right? Or
Oh,
did
they said, let me explain to you why women are better investors.
yeah, I think that's a line in there, but the actual
Oh,
title is slightly different.
okay. Right. So what is it?
Consider firing your male broker. Years of research show female investors outperform men. It's an opinion piece in the New York Times.
Okay.
So yeah, feel free to check it out. It's a fun read.
I think, and I want to send a shout out to 𝗨𝗏𝗀𝗀𝗀𝗀 for watching. Now we do fun things here. We send out
Oh,
free
Elle. I know
articles.
Elle.
Yeah,
Elle's in St. Louis. Hello, Elle.
Elle from St. Louis, first time listener, long time. Wait, no, long time, first time caller, long time listener. I had opposite. Um, thank you so much for joining us today. Where can people find you?
Yes, check out my website, financesforfeminists.com, all words, both plural, financesforfeminists.com. I've got a newsletter on there with lots of fun freebies. Got some fun resources on there. As I said, April is Financial Literacy Month. So like if I've got like a list of accountants, all sorts of tax fun stuff. And then if you want to contact me, click on the contact me button and I offer free 20-minute consultation. So financesforfeminists.com.
And again, you can also check the podcast Conversations with Seven Sisters on whatever you listen to your podcast. I follow it on Apple. But yeah, she just dropped her episode today.
Today.
So
Yay.
that's another opportunity to gain her wisdom. So thank you everyone for joining us. Thank you, Ariel, for joining us. And next week's topic is going to be self-care tips to achieve work-life balance with Courtney Holder. She's another return guest. I'm very excited. Um, very excited about the return guest because obviously I love talking to you because I'm like,
Yeah.
so yes, same bat channel, same bat time, meaning the 26th at 3 o'clock on LinkedIn Live. All right, everybody. I'll see you later and hopefully see you next week. And if you want that article, be sure to send me a message with obviously tell me you want the article and your email address where I should send it. And with that, I'll see you guys next week. Bye.